Hello, everybody. Today we're going to talk about how to record a company's accounting. The members of the team are Arturo Francisco Flores Aldaba, Jocelyn Miranda Joaquín Regis, Aleta Janet Molina Mendoza, Ninfa Yasmin Bail Ramírez, and me, José Julián Carrasco Zaragoza.
The daily book is a basic and mandatory accounting record in which of the economic operation of a company on entity are chronological. It's the starting point to record the transition before they are classified in the general ledger. Its main characteristics chronological. Transitions are recorded in the order in which they occur. Systematic each accounting entry follow a standardized format that includes dates of the transition, effect accountings, amount of the transition, brief description or concept of the operation, and legal basics. It's a mandatory documented accounting to accounting and tax rules of most countries. Important serves as evidence of the transition made. It's allowed to organize the information for sequent transfer to the ledger, facilitates accounting, auditory and accounting analysis after recording in the journal the operation and transferring to the ledger to organize the information by account.
So now I'm going to explain how the T accounts work. In accounting, the T accounts are a visual tool used to record and organize financial transactions. They are called T accounts. They resemble the letter T, making it easy to separate debits left side from credits that are the right side. How do T accounts work? Each account is represented as a T and shows how the transaction affects a specific category that can be assets, liabilities, equity, revenue, or expenses. In the left side, which is debits, it is used to record increases in assets and expenses and decreases in abilities, equity, or revenue. In the right side, that are the credits, are used to record increases in liabilities, equity, or revenue, and decreases in assets or expenses. Why are T accounts useful? Those are useful because it helps you to understand how transactions affect different accounts. In the second, I will say that as a foundational step for preparing journal entries and tracking account balances. And as the third, I will say that is to ensure the debits equal the credits, maintaining the accounting equations, assets equals liabilities plus equity. So that's basically what the T accounts are about.
The trial balance and T accounts are closely related in the accounting context. Science both are used to record and analyze the financial transaction of an entity. That is why I am now going to talk about the trial balance, which is an accounting report that represents in a systematic way the debit and credit balance of all general ledger accounts at the given of periods, with the purpose of verifying the equity between the total debits and credits and checking the correct application of the double entry participle. The trial balance shows the balance of all accounts, debits and credits after recording the transactions in the T accounts. Allows to verify that debits equal credits, ensuring that double entry is respected. It is organized by showing account note, total debit and credit transactions, balance of each account. The trial balance is important because it is fulfills several key functions in the accounting process, among which the following stand out. Number one is verification of the double entry. Allows confirmation that total debits equal total credit. Number two, identification of errors. Facilitates the detection of discrepancies or errors in the recording of transactions, such as omissions, duplication, or incorrect calculation in the general ledger. Number three, basis for adjustments. Several as the starting point for making necessary accounting adjustments prior to preparing the financial statement. Number four, financial summary provides a consolidated view of the balance of all accounts, allowing accountants to quickly assess the preliminary financial position of the ender. And number five, compliances and control helps comply with accounting regulations by providing a clear and verifiable record of accounting transactions, contributing to internal control of financial transparency.
Income statement. An income statement is a financial report that shows a company performance over a specific period. Its main function is to determine whether the company is generating profits or losses and to provide a clear view of how revenue and expenses are being managed. This helps managers, investors, and accountants make informed decisions about the company. Structure and composition. Revenue sales represent the total money received by the company for its products or service. Cost of sales. It is the direct cost of producing or acquiring the product sold or service provided. Gross profit. It is the difference between revenue and cost of sales. Operating expenses, including general expenses such as administration, sales, and marketing. Others income and expenses, including non-operating income or extraordinary expenses. Profit before taxes is the profit tax remains before deducting taxes. Taxes: the amount that must be paid to the government based on the profit is earned. Next profit. This is the final profit after taxes are deducted. Have to evaluate whether the company is generating enough income in relation to its costs and expenses. It allows decisions to be made about continuing or adjusting operating process. It facilitates tax filing and ensures that the company complies with its tax obligations.
I'm going to explain a balance sheet. A balance sheet is one of the most important financial statements as it provides a snapshot of a company's economic and financial situation at a specific moment in time. Its primary purpose is to show what the company owns, what it owes, and its net worth, enabling informed decision making. The balance sheet is divided into three main sections. The first one is assets. These are the resources the company owns that have economic value. All current assets are those that they can be quickly converted into cash, such as cash on hand, account receivable, and inventory. Unknown current assets are long-term research like land, buildings, machinery, and equipment. Liabilities. They represent the company's debt or obligation, or current liabilities are short-term debts, such as accountant payables or loans due within a year. Unknown current liabilities are long-term obligations like bank loans or mortgage. Equity, also called shareholders' equity or net worth, it is what remains for the owners after liabilities are subtracted from assets. It includes the capital invested by the owners and retained earnings. Here we have an example in which on the left side our assets are reflected and on the right side our liabilities along with equity, where losses or gains can also be shown. When these are added, the total should be equal on both the asset side and the sum of liabilities and equity.